Greetings, Dr. Jeffrey Scott, and this is my weekend market update for the week ending December 8th, 2024, Sunday. I title this as Divergences. Maybe I should put, and other scary things, increase. Do we need to better assess market risk? Again, my name is Jeffrey Scott, and my email address is hgsidoc@gmail.com. As always, this is for educational purposes only. Any recommendations should be taken in the spirit of education and not be considered investment advice. The intent of this video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk. You and your loan are solely responsible for any investment decisions you make. I may own or intend to sell any stock mentioned in this report. Trading stocks and options should be considered risky, and you should consult with your financial advisor before making trades. I have tools for multiple platforms, but I'm an independent trader. In the first part of the PowerPoint, I'll show some snapshots of current data to make my argument on the market, and then I'll use wealth charts to do my top-down review. I do post and do reviews in TradeStation, TradingView, Market MRI Pro, which is my new tool. And if you have more interest in that, just contact me for more information. All right, it's that season. I don't know if I'll be speaking. I haven't been invited yet, but my tools are on wealth charts. I'm a big supporter. It's a really comprehensive and great program with a great team led by Rob Hoffman. The event is the weekend of the 13th to the 18th, or the week of the 13th to the 18th, which also coincides with the JP Morgan Healthcare Conference that I'll be at as well. You could see it's about a month away. If you haven't already signed up, the address is right there. I'll put that in the content section of YouTube, the remarks. If you haven't been to one of these, it's really a great session. Rob knocks his heart out and does a bunch of things during and after the scheduled times. And if you don't have wealth charts, it's the best time to buy it. And if you have interest in my app, just let me know. You can buy it during the session as well. Market analysis pre-market. I post these when I'm not traveling at stocksanddocs.com. They're designed to be 5 to 8 minutes. Sometimes they go a little bit long. The intent is to do a quick of what I'm looking at and what I think the market's doing. I did develop a Google group. I had an email list, and I was tired of getting spam notifications, so I'll let Google Group do it instead of me. So the Google Group is called Top Down Trader. How do you join a Google Group? You sign in to Google Groups. Just go Google Groups in Google, search, find all groups, and then go to Top Down Trader. I'll get notified that you sign up, and then I'll approve you, and then you'll have a chance to go ahead and you'll get my nightly newsletter and other cool stuff. Major markets tell the story. Two things before I even go further. Look what's up at the top. ARC Innovation is up 20% on the year, 8.5% the last 5 days. It's up 70% since the 52-week low set August 5th, 2024. I guess Kathy Wood is laughing now. If you look at the MAG 7, you could see they were up 6.5% on the week. So it was a very strong week for large cap tech. Now, the problem is you look everywhere else and it wasn't nearly as strong. The NASDAQ Composite and the Q led up 3.3% for both of them. And you could see how they've done since the beginning of the year. They're 28 and 32%. Notice the NASDAQ 100 lagged on the week versus 100 equal weight lagged on the week. Here's the spider at 0.9, 0.2 on Friday. The Dow and the NYSE were down less than 1%, both down on Friday. And then the Russell 2000 down on the week after a couple of really strong weeks, although up on Friday. You could see the equal weight S&P underperformed the S&P as well. From a sector perspective, no surprise, all the sectors are up on the year, led this week by discretionary tech and communications, as we saw some of the mega cap tech and communication stocks outperform. Using Sagar's Q Edge tool, I call this a 50-50 market. If you look at the S&P 1500, half the stocks are above the midline, half are below neutral. On Friday, 45% of the sectors were up, 46% of the industry groups were up, and 46% of the stocks were up. If you look at the buckets, it kind of is a bell-shaped curve. It's a neutral market, not overbought, not oversold. On the 5 days, you could see there's clear weakening in the market, with 82% of the sectors down, 74% of the industry groups, and 71% of the stocks. So for many people, you've probably found this was a more difficult week than the several prior. In fact, if you look out at 2 weeks, it flips the script, and you could see how strong the market was over the 2 weeks and the month. So is this 1 week telling us that the market's done for the year and we're going lower? Or was it just a pause with some consolidation and rotation before we hit higher highs? I think both are possible. The Q Market Breadth tool, I highlight some skull and crossbones. And the reason why I highlight those is because the concern of what does the Hindenburg Omen mean, and should we be concerned? And I think the answer is yes, we should be concerned. The Hindenburg Omen is a signal that we see at market tops. You have not had a major correction, including the Great Depression, that was not preceded by the signal. And the signal really, to me, is volatility at the high extreme when a lot of the pros are getting out and the amateurs like us are buying because we don't want to miss out on the big rally. So seeing those Hindenburgs is concerning. Down here you could see that growth is over the last several days has been stronger, and you could see that large caps are outperforming as this has pulled back some. What else do you see? This little blue line here is a 13-week new high, new low. We'll refer to it many times. I've been using it for years. And it's been a reversal signal when it gets up into this higher area, and it pretty much works every time. If I look at breaking out the NASDAQ and the NYSE, you could see the Hindenburgs are on both of them, and they're confirmed Hindenburgs. You'll notice the 13-week has sold off pretty hard on both, but nowhere near an extreme. And you'll notice these blue arrows on the NASDAQ, which are called bangos, which is a sign of irrational exuberance. So markets at risk. If you look here across the other major indices, the point I wanted to show you is all of them back around Thanksgiving were super extended. NASDAQ 100 still high on the 13-week new high, new low, but everything else is pretty much broken down. So a lot of that extension to the upside, which was why we expected a pullback or correction, a lot of it's eased off. That's good. On the weekly charts, just look here, this green line, this is my timing model, which I've defined before, but you could see the green line, green on all four in the weekly charts. So the spiders, the Qs, the diamonds, and the Russell, which are my four ETFs that I look for market timing, are all telling me on the weekly, which is the dominant trend, that it's okay to be long. What you can see in green is where that 13-week new high, new low is on each of these. And the only one that's really concerning is the diamonds, where it's at basically 100%, which means that there are no new lows, 13-week new lows on the 30 stocks and the diamonds. Hard to put a lot of credence on 30 stocks. Now on the daily, we are also in a buy signal on all four. You could see some corrective action occurring on the Russell and the diamonds, but if you look at the difference between the white and the yellow is how far you are away from the WMA. And for a stock to shift, or a sector or spider or ETF to switch from a buy to a sell, two things are going to happen. I'm going to have to close below that yellow line, and the bongo is going to have to flip to a sell. So I already flipped on the Russell, but I'm still over 1.5% above the WMA. So that's the first one. Now, how do I use these? Well, as long as the weeklies are long, I'm mostly long. As the dailies start to go the opposite direction, I lose conviction and I start to raise cash. If we're short on the long signal, a longer term weekly signal, when the dailies go to buy, I start to deploy some cash. Here is from my app, and I think you get a lot of information here. You can see 1 day close, Qs, Russell, Spider. Diamonds were the only one negative. Volatility was down 1.5%. And over 5 days, and that's why I bring this in, you could see the Qs really dominated, and the diamonds were down 0.65. The Russell was down 1.22. If we look on Friday, we did see some 1 month new lows creep up on the NYSE. That's the first time in a while we started seeing new lows pop up, so that's something to watch. If you look over here below, you could see 1 day change, discretionary, followed by communication and tech. You can look at themes that were working on Friday: blockchain, genomics, lithium, biotech, which has really been a dud for some time, millenniums. You can look over here and it shows you based upon, just like with Sagar's Q Edge, but I've got the S&P 1500, which is sort of balanced, small cap 600, mid cap 400, large cap 500, versus the NYSE versus the NASDAQ. And if you think about the NASDAQ's got a lot more tech than some of the others, and NYSE might have more banks, regional banks, and oil. So what do you see across the board? It's a pretty 50-50 market. But NYSE had only 21% up and the NASDAQ only 25% up. And according to this machine tool, only 23% were up in the S&P 1500. If I look at the 5 days, again, you can see where the strength was: discretionary, technology, communications. Now, then I like to dive underneath and look at some of the things that I think are important for identifying what's working now. So on the 10-year in white came down, stocks up. 30-year in white came down, stocks up. So we have a big data point coming this week, a number of them, CPI and PPI. So it'll be very interesting to see, because what we're doing with each of these data points is handicapping whether or not the Fed is going to cut. And I probably is a week or two away. I have to go look at the date on that in December. Is there a recession in our near future? One could argue there's always a recession in our future. The question is how near. A lot of the concern is because the yield curve inverted and then it basically just crossed back into positive, although it's barely positive. And these gray bars represent the recessions, and they occur after we cross back above zero. Question is when, and you could see it can be quite some time. Over here on the right, you could see the 10 minus 3 month is getting closer, and so the distance between those two is also tightening as well. Now, if we had a recession, you might expect credit to tighten, not showing here. And as far as the general activity on the Philadelphia, until we get to minus 20, it's not a big concern. But it's at minus 5.5 on the reading from November 21st, and the next monthly reading will not be until December 19th. Something else to watch. Breadth weakened, but not oversold. You can see stocks above the 200 stayed the same. Stocks above the 40 came down. And here is the 13-week or 3-month new high, new low on Warden, and you see it came down as well. Current buckets. Now, I take in this view here in my app, I've got the NYSE, the NASDAQ, the Russell 1000, the S&P 1500. And you'll notice that you see this thick one with clear above it just to the right of middle on all of these. And what's happened is the stocks have shifted to the left. And that shows where we were 5 days ago. And you could see that we have increased versus 5 days on some of the lower bucket numbers. Below the Bollinger Bands, we're starting to build up, but nothing extreme, and we're nowhere close above. This is bothersome to me. divergences. And look at this divergence as the AD line in the NASDAQ composite is heading down and price is still going up. And on the NASDAQ 100, we haven't really turned down on the AD line, but the rate of ascent versus price has slowed down. And the same thing on the NASDAQ, on the Russell 1000, we've turned down on the AD line and we're just barely turning down on the price. So I do think we have some risk here with these divergences. Hindenburgs are firing, and I mentioned what they are before. It doesn't always end pretty. Right now we haven't piled up the new lows. We still have new highs. So it is what it is. It may, as I said, it may not end pretty. Now the markets turned down on the week, kind of, sort of. What this shows me here is, I think that's fine because I think the overall markets did turn down, especially the last couple of days. You take out the tail, you take out the head because this gray line shows the number of stocks. And then I think you can make the argument that this line increases. Now, what are we looking at? The height of the line is the return in the market, and the horizontal is the ERG, which is EPS rank plus relative strength rank plus group rank. So as the ERG went up, the performance went better. That says growth stocks led. Clearly, that's correct. Now, if you look at here, better performance on higher earnings per share, better performance on higher relative strength. As a growth stock investor, that's what I kind of live for. And we see that. If you look over here, and we look at some of the performance of groups from Friday to Friday, first I'll show you the S&P 500 was right here, was up 0.87 over 5 days. Now, in yellow are some of the IBD-like groups that we follow. IBD 50, Mike Scott puts out a group of high-quality growth stocks, the Market Smith 250, IBD 85, the weekend review. And interestingly, the IBD 50 and Mike Scott's group really outperformed. And then here's my buy watch, which really wasn't that impressive from a percent right or wrong, but the winners did well, up 3.89%. The high relative strength group was up 1.94. Filtered buys, where I apply additional filters, was up a bit, not great, 0.96, beating S&P 500. My stocks were up a little bit on the week that I own, but this assumes it equal weighted and their stocks may not have any reality to what my performance really was. And then the ones that I picked as likely to go down were down 0.89. So a mixed week for sure, a lot more red than we've seen over most of the recent weeks, which says a lot of things were going down and growth outperforming. Now, a couple weeks ago, I think November 21st, maybe 24th, it was before Thanksgiving, we put together what I call the leaders list. And what is a leaders list? This is something I learned from Ian Woodward many, many years ago, probably 2 decades ago by now. When the market's at a top, build a synthetic index of 20, 30, 40 stocks that are leading, no more than 2 in an industry, and then track that index. And when that index breaks, it tells you the leaders are broken, and usually the markets will follow. I don't pay attention to anything else on the chart, just price. And what you could see is the leaders are still going higher. And as long as I see that, I've got to think that the markets are still going to go higher, but something that I'll be watching. Know your news and earnings. I already prequelled this. We've got some productivity on Tuesday. We've got CPI complex on Wednesday, jobless, and the PPI on Thursday, and imports on Friday. A lot of things there, and we're not in a period of time where these things don't matter. I think the Fed is still deciding. Now, when I looked last week, I think it was 75% participants were predicting that the Fed's going to cut. But looking at this, there's a lot of information between now and the Fed date that could change that. From an earnings perspective, there's still earnings out, and it's not time to go to sleep on earnings. Toll Brothers, Ollie's Retail, some of the stocks that we follow closely, Adobe, and then Broadcom, Costco. I really like Broadcom's chart, but that fact that it's got earnings coming has to keep me awake. Right here, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. So we led by mega caps last week. We talked about that last weekend, about how the SMH was sitting right on the 50, and maybe it was either that or it was on Monday on my top-down trader group, and I thought good chance NVIDIA would lead the market higher, and it did. Broader markets lagged. Only 3 S&P 500 sectors were actually up on the week. Breadth weakened, and we have clear divergence on the NASDAQ composite. Early evidence of this on the Qs. This is versus the AD. You'll see when we look at wealth charts, we will have divergences to RSI and others. Again, lots of data, so we can see volatility. My models still say to be long. That gives me direction. Seasonality is positive, but we have corrected in recent past in December. I like to take some profits off as markets move higher and have trailing stops to take me out early. Note, as we all know, trailing stocks don't work so well if your stock market gaps against you. Once again, stocksanddocs.com is a place you can go to get my daily videos. If you sign up here, then you'll get an email when they're out. I don't control the distribution. I post the videos either late night or early morning, and the team at Become a Better Trader takes care of that for me. Again, if you want to get earlier access to my videos, if you want to get my comments and what I think is going on in the market, access to discounts on my tools, and the ability to interact during the week, why don't you look at Top Down Trader Google Group? It's got a round cost of $0, meaning nothing, no obligations. You don't have to own my stuff, nor do you have to be considering owning my stuff. I really use it as a two-way vehicle for me to interact with other traders. Let's go on and take a look at the charts. And I'm looking right now as to when and if I'll have a meeting this year. Typically, I like to hold one in Orange County in June, and then a second one in December in Florida. I've been too busy the last couple of years to pull off the Florida one. I'll be reaching out to my friends in Orange County to see if they want to start planning for something this year. All right, leave it open just in case. This is Wealth Charts for those who haven't seen it, and to me, it's got such a big user base. I like using it for these reports because it allows people who bought my tools and who bought the product to see how I can use this for top-down trading. So let's start with the index page. We already know the timing model, which is built in here as well. So Friday, you could see we moved up and then we traded lower most of the session. And if I look at the rest of the ETFs, and I think this is important because Friday was a weird day where there was a very big difference in performance. And I think we already know that the S&P was a middle performance. This is going to be the Qs. And then down here you have the Dow, the Russell, and the mid caps underperformed on the session. And it's a nice thing to watch during the market. It gives you a sense of what's working and what's not working. As far as the week goes, Friday, Thursday, Wednesday, Tuesday, Monday, didn't do much the first 2 days, and then the S&P gapped up and traded higher into the end of the week, and this is a 5-minute chart. Now, don't be deceived, because remember what I showed you in the beginning, the markets weren't all outperforming this week, and we did see that different behavior. If we look at the S&P on the daily, this white line is a divergence. And sometimes divergence triggers, and sometimes it doesn't. But it tells you to be careful. We had it kind of a skinny day, up 0.19. The doji at a high, all-time high set on the S&P, starting to move further away from the 200 and the 50. I think that, a pullback at some point is inevitable. We'll see if that divergence lives up to that, and the 50 would be an obvious target. And right now you could see that 50 is about 22 points, a little over 22 points below. If we look at the daily on the S&P, you can see another pretty session in the markets. And you could see here breaking out all-time closing high, just off the all-time intraday high. And on the week, it was up 0.87. If we look at the daily Qs, you could see the lovely divergence sign here. Also new closing highs, new all-time highs. And again, that 50, which is about 27 points away, 5%, would not be a horrible pullback. And, I'm sort of building my case that that's your first support. There could be support in this level, but by the time, which is the prior high and where we sort of went sideways in here, but my guess is the 50 will be above it by the time we pull back. If I look at a weekly on the Qs, you could see a candle closing either at the high or just off. Let's see what it says. 526.48, and the high was 520, so 24 cents off the all-time high on the Qs. It's hard to be unhappy with markets that are at all-time highs. But even on the weekly, you saw that RSI divergence come in. The diamonds hit an all-time high earlier in the week and came back Thursday and Friday. And you could see that divergence has fired, and we've seen a little bit of a pullback. So on Friday, down 0.34. And on the week, you still had a pretty much, it's not quite an inside bar, down 0.65 on the week. And lastly, on the Russell, hit the all-time high back here, which was a pivotal day, November 25th, because that was a high from November of 2021, and it's come back steadily. Right now, it looks like it could just be a flag. It's orderly, and here was some divergence here, and you can see higher highs on price, but on the RSI, not. All right, and if we look at a weekly on the IWM, you could see, as John Person defines it, a low close doji occurring, which is a bearish signal after an extended move on the Russell and down 1.22%. So that's what I see in the markets. Let's look at commodities. Gold and silver below the 50. Oil has broken down. Natural gas. I just love this chart. It's going to have to be one of my presentation charts because, I'm a technician at heart, amateur, but still a technician. And I just think it's amazing how this thing, every time it hits the 200, it fails. And I was just trying to go back further, but I'd have to get more data on there, I think, to see more bars of the 200, because I got a feeling I'll see even more of that if I go back further. But don't need to get stuck on this, but natural gas, until it breaks and closes above that 200, it's dead to me. And the 10-year came back nicely on the week, down on the day 0.57. And I think, let's look at it, we know from the week it's down as well from the PowerPoints. Back on the indices, I missed a couple of things. Got to shut that down. And what I wanted to point out, let's look at the VIX weekly. You can see it was down another 5.5%. The question is the dollar peaked? And as we've talked about, the dollar was getting into an area where it had failed previously. And let's just look at the dollar on a weekly, and you can see the dollar was down, actually up 0.27 on really most of the movement within the prior bar. All right. Looked at the timing, the models already. Let's look at some of the other breadth things I look at. So I like to look at TLT versus the SPY. Why? Because if we were having a recession coming in, I would expect this thing to spike. We're staying below the trend line, no sign of recession. I like to look for spikes in the IEI to the HYG. Why? Because we get spikes if we're getting credit tightness. We don't have a recent spike. This is disappointing where I look at the strength here of the RSP, the equal weight S&P versus the spider. It's broken down. The same thing with the Qs. This is interesting here. The small cap or the overall equal weight semiconductor ETF XSD is actually holding its own versus the SMH, which did bounce this week. If we look at the hourly charts to see where the strength is in the market, let's see what they tell us. Whoa, look at industrials taking a dive. And this was one of my leaders last week. Oops for them. And look at this. Materials way underperforming the S&P. Communications look great. Energy underperforming. Financials are in the middle. Industrials underperforming. Technology, a pretty massive rebound. Staples, real estate, utilities underperforming. These are the more defensive plays. And the fact that they're underperforming makes me think the market's not about to go crazily down. The big winner, as it was a week ago, and that stayed a winner unlike the other one, is discretionary. And here was the star last week, so you could see the power it had. Another strong week for discretionary. And healthcare is just still doing poorly, although biotech moved up a bit. JP Morgan's that second week in January, second full week in January, sometimes we see healthcare run into that. So communications, technology, and discretionary. These are ratio charts. It is not the sector's chart. It's how that sector compared to the spider. And I want to be buying those sectors that are outperforming. All right, now let's go into my scanners, and let's just start with a heat map and look at the markets as a whole. So mixed day on the S&P 500. If you look at the NASDAQ 100, also mixed. But let's look at some of these big cap tech stocks. Meta has broken out to new highs and is certainly leading. We talked about it last weekend as it was at a very natural place to do something, sitting here right around the 50. Had a squeeze, came out of the squeeze, relative strength in OBV, and the nice thing about this sideways movement it had, it's not extended. So you could buy more. NVIDIA last Friday, let's see if this was Friday, this was the 27th, maybe it was Wednesday, but middle of the week last week, 1, 2, 3, 4, 5, yeah, Wednesday was close sitting on the 50. We moved up on Friday, and it had a strong week, although really didn't do much the last couple of days, sort of. But on the week, you could see NVIDIA was up 3%. I want to see what it does here. Is it going to come back to the 50 again? Tesla, leading. Amazon, breaking out and leading. Apple, also, slowed down a little bit up here. After a big move off the 50 and not extended by high jump, although hard to believe, but that's what it says. And these stocks all look great. Are they at a buy point? Here's Microsoft is coming. And you could see Microsoft had a big breakout as well. Which one is buyable here? That's what Google looks like. This one. This one at least is not extended and has not broken out to new highs. It pulled back into the 17. That one would be one that I'll be watching. And we're going to come back to AVGO, so I'm not going to look at it right now. All right, so a lot of strength here. In fact, there's a reason why mega caps and mags led. We just looked at them. If we go into the wealth scanner, I have a list I call my top-down indices, where I have a large number of ETFs for sectors, industry groups, and themes. And I look at a couple things. I see more above 800, but nothing at 850. So healthy, I guess, but not as healthy as it's been when you'd see a lot more stocks sitting there above 800, or a lot more of the ETFs. Internet, discretionary, Core 500, S&P 500, technology, internet, communications, ARKK, MILN, and ARKX, and ARKF. All right, now, so from a top-down perspective, I've already declared that I'm still long. Risk has increased. I'm not without concerns, especially with the divergences in the Hindenburgs. I've looked at the sectors, and as I look down here, what I see is a lot of internet discretionary tech stocks. That's where I want to be playing. And now I'm going to jump into my CAT scanner. Now, I like to buy stocks typically that are pullbacks and uptrends. So I could look at a zillion charts, which I do, or I could try and scan for them. Often I could pull those stocks up. Let's just looking at something like ACN. And, it's clearly an uptrend, and it's pulled back on the more macro scale. And what I'm basically looking for is a stock who recently stubbed its toes and the daily bongo went red while the weekly bongo is green. It's not perfect because you can miss early reversals. But what I have here is a combo leaders list. Let's just look at tech, or let's look at discretionary and then technology, and see if there are any things that are clear cuts that are setting up. Now, as I've done my work with markets over 30 years, it's hard for me to find stocks that have gone up significantly without starting with a gap, big volume, a breakout, or momentum. So I'm looking for those four things. So here, this scan is going to look for pullbacks and uptrends that have my dots. So let's look at Lululemon. Been looking at this for a couple of weeks. Actually liked it when it broke out here, and that to me was a good time to get into it. And you could see on earnings, 5% beat, massive volume. You have three dots: earnings, breakout, momentum, coming out of a squeeze. It's extended here by the high jump, but when I see we're going sideways for a while and the 200 so close, I ignore that. I love the relative strength in OBV. Obviously, this is something that is way off its prior highs. This is the 50-week moving average. I think Lululemon looks great here. Ulta, similar pattern, breaking out above the 200, closing in the lower part, also on earnings. 13% beat, volume breakout momentum, great relative strength in OBV, not extended. I kind of like the other one better, but this is another one. I don't like how it finished, but this may just be the market. Woof, Petco, cheap stock. And what I didn't like about this is the fact that it closed in the bottom of its channel. Still had a massive volume, big gap up, had earnings the prior session, lost 2 cents instead of 4 cents, not extended, coming after a prolonged base, nothing wrong with Woof. Anything else here that stood out for me? I don't think I'm buying Whirlpool. It's not my type of stock, but it really is the quintessential pullback here in an uptrend. Clearly, if you look at the weekly, and that's probably a better place to look for uptrends, we're in a strong uptrend. On the daily, you could see that pullback to free parking, which is the 50. And then on Friday, we moved up above the 17 from a squeeze. Relative strength, great. OBV turning up, not extended. So that was some of the discretionary stocks. How about technology? DocuSign. This is a name that did really well in the COVID era, but I don't have a day go by where somebody's not putting a DocuSign in front of me at work. Now, This one had a beautiful breakout, but I'm going to put this in the category I missed it because this one is extended. Look at the weekly chart. Must be earnings, and where the earnings were a little bit of a beat. Gap up, volume, breakout momentum. This is the extension. Relative strength and OBV are awesome. Just probably too far gone. HPE. Actually just bought a computer from them, which is new. I don't usually buy from them, but they had something I liked. If I look at this, you could see a small beat. Again, big uptrend, pull back in here, breaking out. That's my EMS signal. Great volume, 4 dots, not extended relative strength and OBV. These are really nice looking setups. VEEV, software and healthcare and data science. What's probably extended? Let's see what it says. 100% too extended. Talk about one that really has done well, and I just want to go revisit it because of some of the signals that we've been seeing. And I really want to revisit here. This was not the best time to buy it because it had already run a lot, but it would have been a really good time to buy it. And I want you to look at what occurred. It pulled back. Here's that bongo going from red to green. Here's my wealth signal. Good volume with after earnings that it beat. Gap, volume, breakout momentum from a squeeze. Yes, it was extended. Relative strength and OBV. Now, I would rather see a little bit of a hesitation here before it went higher. But a lot of times these gaps, especially the ones that Morales and Katcher refer to as Bible gap ups, can gap and run, and Palantir really did. Look at it back here. Same exact thing, not related to earnings. Even better, pull back towards the 50, not as extended here. And look at, had a little bit of digestion and then went again. So Palantir has just been a great stock, but I got to buy it when it pulls back. All right. Now, there are other great stocks that I looked at this weekend. Let's go to this combo buy list, which is a bigger buy list that I post. And now I'm doing my posting of these lists on Top Down Trader. Sometimes on YouTube, but mostly on Top Down Trader. So I want pullbacks and I want combo leaders. And there's DocuSign, HPE, Lulu, Alta, Vive. All right. This is a case where the stocks that were in the top sectors and industries are right up top. Didn't look at Newmark. I don't know what Newmark Group does. I don't know if it's a REIT. Uptrend, sideways move, and breaking out. Why does it not get credit for a gap? Probably because it didn't have enough of a move. But good volume, breakout momentum from a squeeze, not extended, relative strength and OBV look very good. NMRK, I just don't know what that stock is. Let's see something. Do I have, let me go into this. Let me go into MarketSmith, Market Surge now. Got that? Dash, 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 dash. Open the chart. I think we were looking at Newmark and MRK. Okay, is a real estate development. Commercial real estate services. 17% growth on $1.38. Yeah, I mean, I like that. I mean, I think that one looks interesting. So it showed up on my scan. I just didn't know what it was. Sideways movement, gapping up here. I put that on my buy list. Didn't know what to do with this guy, NNOX. 3D printers. really had a short hour in the market and have been dead for a decade. Had a big move, which it lost on Thursday. On Friday, a big move up. Massive volume came in, gapped up off of Thursday's close. Looks interesting to me. Breakout momentum out of a squeeze, not extended. Relative strength and OBV look good. I don't know if there's a story here. This triangle is a launch indicator, a special thing from Rob Hoffman. Others that looked interesting to me here, Bridge Bio. Again, don't know anything about this fundamentally. Don't know them. They're not in my business. Not a customer of mine. Pretty long base here. And broke out above the 200. Decent volume, breakout momentum, not extended. Relative strength and OBV look good. Probably worth doing a little bit of news review and see if there's something there. Coin, one way of playing the Bitcoin surge is coin. Notice the golden cross here. Big gap up, sideways move. Looks like it's running again, not extended. The one that is in the same space that I've been playing it for a while, Hood, will look even better. What a great run. Anything else here that looks Z-Scaler was one that I liked as well. We have a little pullback here and now trying to break higher. And I could go on for hours because, trust me, there were a lot of good-looking stocks this weekend. So let me give you a couple others that I like. Here's a cheap stock, SERV, Serve Robotics. Don't know anything about it. Don't know anything about the fundamentals. Don't really care about that. I trade the chart. Basing, pull back to the 50 and launching off the 50 with great volume, breakouts, 2 momentums in a row, which gets me excited. Relative strength and OBV look good. It's probably a recent issue because there's no high-low jump. It requires almost a year's worth of data. So SERV looks interesting here. KVYO, Clavivo Inc. Run up, pull back, breaking out here. Decent volume. And then I'll leave you with one that I'm not showing you because of the chart as much as another fact. HTGC, Hercules Capital, pulled back pretty hard and had a nice Friday, moving back up above the 200. A break above the 50 with the relative strength OBV not extended. Maybe this thing's getting ready to run. But more so than that, what I like about this, pays a 9.8% dividend. So we looked at the markets. I'm bullish with caution. We looked at sectors. We like technology, discretionary, and communications. And we've looked at the heat map, which showed the strength in the mags. And then we looked at technology, discretionary, and then I flipped to bottoms up and I showed you some of the stocks that I liked in the combo leaders list. I hope this helps you. I'd love to see you join me on the Top Down Trader Google group. Again, no obligations, no cost. But eventually I'd like to see people going back and forth in discussion, not just coming for me. Have an awesome rest of the week. I'm going to go back and watch some football, but stay safe. We'll see you next week. Or even faster if you join Top Down Trader.